For decades, your goal was simple: accumulation. Every decision was focused on compounding and growth. Today, that goal fundamentally changes. You are no longer focused on adding assets, you are focused on extracting perpetual, tax-efficient income without compromising the principal. This is the art and science of decumulation. This is where the principles of the 4% rule meet the realities of inflation, sequence of returns risk, and tax liabilities. In this capstone deep dive, we will master sequence of returns risk, the single greatest threat to your early retirement, the dynamic withdrawal strategy, replacing the fixed 4% rule with an adaptive, sustainable system, the asset liquidation hierarchy, a tax-optimized plan for which assets to sell first, the permanent income engine, structuring real estate and digital assets for generational cash flow. This transition is the ultimate test of your financial discipline. Success means security forever. Failure means running out of money in your later years. 1. The threat to perpetual income. Sequence of returns risk. 20 minutes. The most sophisticated threat to your financial independence is not a late-life bear market, but one that occurs early in your retirement. A. Defining sequence of returns risk. SRR is the risk that poor market returns occur early in your retirement, just as you begin making withdrawals. The problem: if the market drops 30% in year 1 and you withdraw 4% of the original principal, you are selling assets at their lowest point. This permanently reduces your principal, meaning there are fewer shares left to benefit when the market eventually recovers. The ratchet effect, the early loss, is amplified because the portfolio never has a chance to regain its initial momentum, making a full recovery mathematically impossible while withdrawals continue. B. The defense, the income bucket strategy. To defend against SSRR, we use a tiered cash flow system. Bucket 1. The safety net, 2 to 3 years of living expenses held in cash, high-yield savings, or ultra-short-term bonds. Purpose: to cover expenses during a bear market without selling depressed assets. Bucket 2. The buffer, 5 to 7 years of living expenses held in intermediate bonds, CDs, or high-dividend ETFs. Purpose: to refill Bucket 1 when the market is stable. Bucket 3. The growth engine, the remaining portfolio held in diversified growth assets, index funds, real estate, business equity. Purpose: to generate the long-term inflation-beating returns. The rule: you only make withdrawals from Bucket 1. You only replenish Bucket 1 from Bucket 3 when the market is above its all-time high or has achieved a significant sustained recovery. 2. The dynamic withdrawal strategy, 25 minutes. The fixed 4% rule is too rigid for long-term security. We replace it with an adaptive strategy that adjusts to reality. A. Why fixed 4% fails. A fixed 4% annual withdrawal, adjusted for inflation, works on average, but it forces you to sell assets during the worst possible moments. We need flexibility. B. The floor and ceiling rule, dynamic adjustments. Implement 2 simple responsive rules based on the previous year's market performance. The floor, required adjustment. In any year where the portfolio declines by 10% or more, you must cut the withdrawal amount by 10%. Purpose: to drastically reduce the principal drain during early downturns. The ceiling, optional bonus. In any year where the portfolio grows by 20% or more, you can take a 5 to 10% bonus withdrawal on top of the standard amount. Purpose: to reward good market conditions without making the baseline withdrawal rate unsustainable. The result? You sacrifice lifestyle marginally during bad years, but you dramatically increase the probability of your portfolio lasting perpetually. C. The tax-optimized withdrawal hierarchy. The order in which you extract funds is critical for minimizing taxes. This is your liquidation order. Required minimum distributions, RMDs, if over age 73 or current RMD age, take these first. Taxable accounts, harvesting losses. Sell assets in your standard brokerage account. You want to sell assets that have been held for more than 1 year, long-term capital gains tax is lower, and harvest losses to offset future gains. Tax-deferred accounts, 401k, or traditional IRA. Withdraw funds from accounts that have never been taxed. This withdrawal is taxed as ordinary income, so draw only enough to stay in a lower tax bracket. Tax-free accounts, Roth IRA or Roth 401k, withdraw these funds last. They are tax-free and penalty-free. Keep these growing for as long as possible to benefit from decades of tax-free compounding. 4. The Perpetual Income Engine. 20 minutes. The ultimate goal is to rely as little as possible on selling investment principal. We achieve this by optimizing the natural cash flow from your business assets. A. Real estate recalibration. In the accumulation phase, debt was your friend, leverage. In the decumulation phase, debt is a vulnerability. The target: prioritize the use of excess cash flow to pay off all rental property mortgages within the first 5 to 10 years of retirement. The result: a mortgage-free property produces pure, high-margin cash flow. The net operating income, NOI, becomes the true, passive, predictable retirement income, minimizing reliance on stock market returns. B. Digital assets as permanent income bonds. Your scalable digital systems, SaaS, courses, newsletters, must be managed like a permanent bond. The goal: extract 100% of the profit as income, but maintain a fixed minimal capital budget for delegated maintenance and minor updates. The model: do not sell the business unless you need a massive capital injection. Instead, treat the business as an annuity, a predictable, recurring cash flow source that requires minimal time from you, Q2 maintenance only. IV. The Eternal Wealth Structure. 15 minutes. The final step is to lock the entire structure into a legal framework designed to last multiple centuries. A. Dynasty trusts. Move beyond the basic living trust. A dynasty trust is a mechanism used by the ultra-wealthy to pass wealth from generation to generation without incurring estate tax. How it works: the trust is structured to last for many generations, often utilizing the rule against perpetuities exceptions in certain states. The principal is protected, and only the income is distributed to beneficiaries. The benefit: it prevents the shirt sleeves to shirt sleeves problem by legally dictating that the assets are maintained for perpetuity, shielding the wealth from the spending habits and legal risks like divorce, debt, of your heirs. B. The family investment policy. The transfer of wisdom. Do not just transfer money, transfer the operating manual. The document: create a formal investment policy statement, or IPS, for the trust or family council. This dictates the acceptable asset allocation, for example, 60% stocks, 30% real assets, 10% cash, the permitted withdrawal rate, the dynamic SWR, not the fixed 4%, the investment mandate, long-term indexing only, no speculative trading. The result: you ensure that the financial principles that built the wealth continue to govern its preservation long after you are gone. Conclusion: the legacy of control. This is the infinite game. You have successfully navigated the transition from accumulator to protector. By implementing the dynamic withdrawal strategy, the tax-optimized hierarchy, and the dynasty trust, you have done more than secure your own freedom. You have built a permanent, durable economic engine for your family's future. The final mandate: begin the process of meeting with the specialized trust attorney today. The structural work is the last step to eternal security.